Hi, and welcome back to Channel 11. It was a November to remember with some epic rallies in the equity market. We can see many parts of the equity market up 8, 9%, even emerging markets that's been lagging this year. So a whopping 37% return in the NASDAQ with tech leading the way. Japan, interesting story there this year. Even with the weakening currency, you're seeing up 28% now year to date. S&P 21% return, global equity up 17%. So strong returns outside of EM and the UK here. Also, we see Russell 2000 small caps lagging. If this equity market rally continues, I think there could be some catch up there in the small caps. As we look at sector performance, clearly tech is leading the way up another 13% on the month, now up 50% year to date, pretty amazing. Consumer services up 47%. So really strong returns across the board. The laggards has been energy this year, with kind of oil going sideways to down, consumer staples, healthcare. Some of the defensive parts of the market have actually been doing poorly. Good rebound in real estate, which had been lagging, up 12% on the month, but still one of the laggards this year, with the broader market being led by that tech sector. Commodity performance, kind of a mixed bag. Gold hitting new highs this year, selling off a little bit since that last couple of days. Copper up strong on the month, but flat on the year. It's really been a story of weakening commodity prices for much time. You can see the commodity index on the far right is down 2.69% now on the month, and year to date down 13%. Here's another snapshot of commodities. It really peaked in 2022, and it's been continuously coming down, which I think is one of the reasons that inflation has also been coming down, and it should be supportive of bond prices, as we've seen a decent rally in the bond market. What a rally it's been. I was on the road much of September and October talking to investors. Seemed like the bond market went down every day, and it almost did, going down every day. But what we were following was the positive economic data that pushed rates higher, eventually flipped, leading rates back down. So you've seen a major rally across the curve. 10-year Treasury on the right, you can see that it's now rallied almost 100 basis points off its highs. I think 509 was the intraday high on the 10-year. And now we're sitting right at that trend line. It's kind of like a 3-year trend line. And I think the 10-year is going to go test the 200-day moving average, which is around 4%. And we'll look at that in a second. Here's November fixed income returns, just gangbuster returns across the board. You can see on the far left, higher quality parts of fixed income, treasuries, mortgages, which have been one of the laggards. I mean, literally everything is up except for CCC levered loans, which were already up a lot, and they're not fixed rates. They're not enjoying the duration rally, with a 4.5% rally for the index on the far right, the yellow. Now, this rally looks huge, but you got to remember, we started from a big sell-off. So as we look year to date, the index is only up 2%, but at least it's up. I think it's safe to say we probably won't end with a third negative year for the index. We had 2 back-to-back negative years, 2021, 2022. But the high-quality parts of the market, they've rallied a lot, but now they're just barely up on the year, up 1-2%. Still, the leaders are really riskier parts of the market, credit parts of the market. You can see corporate bonds up 4.3%, high yield up over 9%, bank loans up in the double digits. So it's really been floating risk has been the place to be. The riskier, the better. And some parts of the securitized markets still doing notably well, up mid-single digits, nothing compared to bank loans and high yield. And I think those sectors are probably due to catch up next year, as we've seen the corporate credit markets rally a little bit faster than some of those securitized markets. So a really big difference in the expectations of investors. This shows you the implied Fed funds rate based upon the market's forward curve for treasuries. And you can see the top line was 1 month ago. Hard to believe so much has changed in this 1 month, but you can see about a month ago, we only really expected about 100 basis points of cuts in the marketplace, with Fed funds, kind of around 5.5-ish, and we expected maybe 3 cuts or so, bringing Fed funds down to about 4.5 by the end of next year. You can see we're expecting, the market is expecting, not saying we expect, but the market's expecting all the way down to 4%, which is about 4 or 5 cuts through the end of next year. So a lot has changed in the marketplace, but the data has changed. Something we were watching through September and October, one of the data points that we thought was pushing rates higher was the fact that economic data was continuously surprising on the upside. The red line is the city surprise index. The blue line is the 10-year Treasury yield, and you can see they moved together up from the summer, And then you finally saw the data start coming in weaker. Started with that ADP report before the last Fed meeting, and you got some continued weakening in the manufacturing PMI. And one of the things that I think is maybe underappreciated is the change in the Treasury's funding schedule, moving funding away from longer term bonds down to the more shorter term bills. And so there's less concern around that long term issuance. All those things culminated together with this epic rally that we've seen. You can see we're hitting that retracement levels across the board. I think 4% is the next stop, but there's potentially more to room. The 50% retracement of the sell-off starting in 2020 would be a 275 10-year. I'm not saying that's my target, but if the technicals play out, there's definitely more room to run. So for those that feel like they've missed it, I don't think that's the case. Is it a great time to buy after this huge rally? I don't think so. I think the market's going to hit some resistance. I think you might get a little bit of a backup to be able to buy a little bit more of a dip on the longer end of the curve, but you surely haven't missed it. One thing we've looked at a couple times is the average returns of fixed income after a Fed pauses, and to the degree that the Fed is already done, which it seems like that's what the market thinks. You can see that Treasury returns here, the Treasury index is in the beige, 8.2% over 1 year, 7.7% over a 3-year time horizon. And as we saw earlier, Treasuries are only up 1. So if history is any predictor of the future, there's probably more room for the 10-year to fall, especially if the economy continues to slow. So just something to think about. You haven't missed it. I know now that it's gone, you want to buy it at 5%, but the reason it got to 5% is because nobody wanted to touch it at that point because everyone was worried it was going higher. I was joking that October of this year at the time felt like October of last year for equities. Nobody could come up with a good reason why equities should rally. In October of this year, nobody could come up with a good reason for bonds to rally, and then they obviously did, because when so much bad news is priced in the case for bonds, bad news being good news, all you needed was a little bit of slower economic data, and that's exactly what we got. So as you look at the things that bond investors should be thinking about, inflation is coming down. We've seen a pretty decent fall in inflation, both looking at core PCE and core CPI. If you look at not the 12-month numbers, but shorter-term numbers, like 3 or 6 months, we're actually below 3% in many cases. So this is all positive for bonds. I think this is one of the reasons that rates have come down and the market now thinks the Fed may cut. Because if you think about it, even if they don't cut rates, if inflation comes down, real yields go up. So holding rates constant, if inflation comes down, real yields go up. So they're actually more restrictive if they keep rates where they are today if inflation's coming down. So arguably, if inflation comes down, to keep the same restrictive tone in the marketplace, they should be cutting a little bit. And I think that's what the market has been sniffing out. I don't necessarily know if the forward curve is sniffing out recession yet. Now, other things that have been helping the bond market, the labor market has been softening. We've seen it started with that ADP report. You had that jobs report the Friday after the last Fed meeting. And here you can see job openings continue to come down. So this is all positive for bonds. Not that this is going to drive a further rally from here. I'll note again, I feel like we've seen a pretty furious rally, and we're probably going to slow down a little bit. But this is all kind of net positive in the sense that we're probably not going to go back up north of 5% unless this data turns and starts going the other direction. Wages also have been coming down, and on the right-hand side, we can see unemployment has slowly been ticking up. This is also partly due to the fact that more people have been coming back to the job market. Maybe they need jobs, maybe they need money because they're running out of those stimulus checks. If we look back through time, this was on Jeffrey Gundlach's webcast yesterday, that historically when you do see about a 50 basis point rise in unemployment, typically that does lead to a recession. So we are on recession watch at DoubleLine. It doesn't mean you have to sell everything and run for the hills. It just means be cognizant that there are risks to economic slowdown. Bonds can do good in that environment. Equities off these lofty valuations maybe don't do as well. So we like fixed income given the valuation differences, where equities seem to be pricing in, no risk of recession here, and bonds maybe can benefit if we do see that further slowdown. I think what the market really got wrong has been the consumer. The consumer is really the resilient part of the market. We look at things like manufacturing. They've been in a recession for quite some time. Housing has been in a recession for quite some time. But here is a chart of the consumer savings from the pandemic, the kind of pent-up savings from the stimulus checks. And the dotted line is what the market kind of expected at the beginning of this year. And if you had kind of extrapolated that line linearly, you would have basically said, hey, it's going to run out by the end of this year. And that's why some economists at the beginning of this year expected a recession right now in Q4, because they thought the savings would run out, the slowing consumer would weigh on the economy. And then after we got that revised Q2 GDP, new data came out where economists revised the pent-up savings, and that's that beige line. You can see it was off by about $700 billion. I mean, that's a lot of excess saving that can still be spent. I think that's why retail sales keep coming in strong. We just had Black Friday and Cyber Monday or whatever it's called, and the numbers didn't look too bad. So I think that's what's kept the economy afloat, is that excess savings, but it is being spent. And if you broke this down by the different cohorts of income brackets, in quartiles, most of the lower quartiles have spent most of this excess saving. So what's left is really the upper quartile, which doesn't really spend as much of their savings anyways. So I think that's going to lead to continued slowdown the consumer. And we can see that when we look at other data points. So we put a tweet out about a week ago noting some of these data points. On the far left is credit card utilization. That's that dotted line that's moved up the most. So once you're done with your savings, what do you do next? You start using your credit cards. And if you use your credit cards, eventually you'll lead to some people not being able to pay them back. So on the right-hand side, you see credit card utilization going up. Now, while this in and of itself isn't a sign that recession is imminent, because we're just kind of going back to 2019 levels, it's the trend that it's important, and the trend is it's rising. I've seen some kind of Armageddon tweets out there where people show the percentage change of the percentage, and I think it's still misleading because, yes, delinquencies are up, but they're kind of just normalizing. But again, this is just a thing to note, thing to look at, and keep your eye on that. Maybe the consumer's slowing, and that could lead to maybe rates falling more as we go into a slowdown or maybe a recession. The other thing that I think is contractionary, and we looked at this maybe 4 or 5 Channel 11s ago when we had the banking crisis going on with SVB, is bank lending. It still has not really recovered. Banks are really not lending. Part of it's because they're losing deposits still, going into money markets. But this is also not good for future spending by small business, which is a large part of the economy too. So again, I don't think these are signs of some impending global financial crisis. It's probably going to be more of a good old-fashioned slowdown or a good old-fashioned recession. But nonetheless, that would be positive for fixed income securities, which have already started a decent rally here. This shows lending standards of banks. You can see when the red line's going up, they're tightening their lending standards. And on the bottom is demand for loans. And when the blue line is falling, there's weaker demand for loans. And we just showed the last 3 recessions, and you can see when there's this kind of divergence between these lines, it usually means, there's a slowdown coming. Less people want to borrow because they think something bad's coming down the horizon. So they don't want to invest into an uncertain economy. And banks also don't want to lend into that type of economy. So these are all signs that, it doesn't need to be a recession, but, it could be a slowdown. And all we need in fixed income is slowing growth, slowing inflation. That's all we really need to have a good backdrop for the fixed income markets. And all the data kind of points that we're getting to that zone. So as we look at opportunities out there, I know we've had a huge rally, almost 100 basis point rally, but we're still higher yields in the start of the year. We're still higher yields in the start of the year. The 10-year started the year around 385. It's sitting around 411, 415-ish. So high quality fixed income still yields 6+%. Those are long run equity type returns. If you go into diversified core plus portfolios, they were yielding 7.5. They're yielding probably more like 7 today after the rally, or high 6s. And I joked that nobody would buy them at 7.5, but once they're backed down to 5, everyone will pile in. That's just the way investor psychology works. So don't be that investor. Don't come in after the rally. Again, right this second, I think the timing on duration isn't optimal just because we've seen a huge rally, but we're kind of in that zone where we haven't seen these levels in a long time. Riskier parts of the fixed income market offer private equity, private credit type returns. So you don't need to lock your money up in private debt anymore to get the teens type returns that's available in public fixed income. Now, clearly bonds that have 10, 11, 12% type yield, they do have credit risk. If equities sell off, spreads will widen. But if you believe in the credit and you can do security selection and credit underwriting, you're going to realize these yields through time as these bonds pay their coupons and eventually mature, hopefully at par. Or even if they take a little bit of losses when you're buying bonds at discounts, you have the ability to take some of those losses too. So we've had a big rally in rates. We've also had a big rally in corporate bonds. This is my favorite what looks cheap report in the fixed income space. Last month, I think IG was all the way up at almost 60th percentile, and high yield was north of 50th percentile, kind of average spread. And they've had an epic run, especially investment grade. I mean, I think it's at the tights of the year, and it's looking pretty expensive. It doesn't mean investment grade corporate credit is bad. I'm just saying on a relative valuation basis, what's really has lagged, and it typically does, are those securitized sectors. We've looked at this throughout the last couple of years, and really it sticks out. These are kind of the AAA portions of the securitized credit markets, and they haven't really widened in spread. They've actually tightened in spread. It's just corporates have tightened so much that on a relative basis, those securitized sectors, I think, look cheap. The market, I think, understands that. We're seeing the deals starting to get priced a little bit tighter, and I think they're going to catch up to the end of this year, but probably mostly through the beginning of next year, because there's not much trading activity that goes on in December. So these sectors, I think, will catch up to corporates next year, and it's where I think some excess return is going to come from, and opportunities are there today. So thanks, everyone. We'll keep this one short and sweet. Hopefully everyone enjoyed the November rally. Good luck through the next year, and we'll catch up with a preview of 2024 to come with Deputy CIO Jeff Sherman to start the next year. Thank you.